NIO has been making waves in the electric vehicle industry, pushing the boundaries of innovation and manufacturing. From cutting-edge materials to expanding market influence, the company is positioning itself as a serious contender in the evolving EV landscape. But with all these advancements, a crucial question remains. Is NIO's stock on the verge of a breakout, or is it facing major headwinds? Let's break down the latest developments, including the upcoming earnings report, and what they mean for investors. Before we analyze NIO's latest moves, take a moment to subscribe for real-time insights into the most promising investment opportunities. One of the most significant breakthroughs for NIO in 2025 is the development of a self-hardening aluminum alloy for high-pressure die casting. This advanced material is already being used in the body structures of NIO's ET9 and Anvo L60 models, improving structural integrity and production efficiency. This is a huge step forward for NIO because it allows the company to streamline manufacturing, reduce weight without sacrificing durability, and potentially cut costs. With Tesla and other major players already relying on gigacasting technology, NIO's proprietary alloy puts it in direct competition with some of the biggest names in the industry. More importantly, this development marks the first time a Chinese automaker has pioneered such a material, positioning NIO as a technological leader in its home market and beyond. This innovation could enhance vehicle performance, improve safety ratings, and reduce production complexity, making NIO's EV lineup more attractive to both consumers and investors. Another major advantage of this alloy is its cost efficiency. By integrating a self-hardening material, NIO could reduce reliance on expensive outsourced components and achieve greater production autonomy. If this technology scales effectively, it could not only improve NIO's bottom line, but also help the company maintain competitive pricing in an increasingly crowded EV market. With growing competition in the EV market, many investors are watching NIO's next moves closely. The company's fourth quarter and full year 2024 earnings report, scheduled to be released in early March 2025, will be a key moment in determining whether its recent innovations are translating into financial success. A few things to watch in this earnings report. Revenue growth. Has NIO's vehicle delivery volume increased, and is it keeping up with competitors like Tesla and BYD? Profit margins. Are manufacturing efficiencies from the new alloy helping to improve margins? Expansion strategies. How is NIO handling international expansion, particularly in Europe and Southeast Asia? The earnings call will likely provide clarity on whether NIO's recent advancements are helping the company turn a profit or if it's still burning through cash to fund aggressive growth. NIO's ability to scale production while managing costs will be key. If the company can prove that its innovative materials and battery swapping infrastructure are translating into financial gains, investors could see a shift in sentiment, potentially driving the stock upward. So, with these innovations and an important earnings report approaching, how does NIO stack up against its biggest competitors? Let's dive into what sets it apart and the challenges it still faces in an increasingly competitive EV market. Before we get into the exciting details, let me introduce you to Moomoo Financial. If you open a brokerage account with Moomoo and deposit at least $1 using the link in the description, you'll get a chance to draw a free stock worth up to $2,000. But that's not all. If you make a net deposit of $100 or more, you'll receive not just one, but 5 free stocks worth up to $2,000 each. And if you're really serious about investing, you can deposit $1,000 or more and get a whopping 15 free stocks, bringing your potential earnings to a staggering $30,000. So, sign up now using the link in the description and get those free stocks. Now, let's get back to the video. NIO's technological advancements aren't just about materials, they also extend to its unique battery swapping technology. Unlike Tesla, which relies solely on supercharging stations, NIO's battery swapping model offers a quick, efficient alternative for EV owners who don't want to wait for traditional charging. This approach has gained significant traction in China, with NIO expanding its network of battery swap stations, allowing for more seamless long-distance travel. NIO has already deployed thousands of swap stations across China and is now expanding internationally. The goal is to redefine convenience in the EV market, offering drivers an experience similar to refueling a traditional gas vehicle. If widely adopted, this could become a major selling point for NIO vehicles and set them apart from competitors. Additionally, NIO's European expansion is picking up momentum. The company is making a concerted push into markets like Norway, Germany, and the Netherlands, where demand for premium electric vehicles remains high. While Tesla dominates in these regions, NIO is carving out a niche with its subscription-based model and premium vehicle lineup. If NIO can execute this strategy effectively, it has the potential to capture market share in high-growth international markets, further solidifying its position in the global EV race. Another area to watch is NIO's research into autonomous driving. The company is developing next-generation self-driving technology, which, if successfully deployed, could add another revenue stream through software-based subscriptions and licensing deals. If NIO integrates its autonomous driving capabilities effectively, it could position itself as a leader in EV innovation rather than just another car manufacturer. While all of these developments sound promising, there are a few key risks that potential investors need to consider. Profitability concerns. Like many growing EV companies, NIO has yet to achieve sustained profitability. The upcoming earnings report will be crucial in determining how close it is to turning a corner. Macroeconomic factors. Interest rates, supply chain issues, and EV demand fluctuations can all impact NIO's growth trajectory. Government incentives. NIO has benefited from strong backing by the Chinese government, but if subsidies for EV production or battery technology are reduced, it could affect the company's ability to maintain competitive pricing. Global expansion risks. While NIO is expanding internationally, breaking into foreign markets is never guaranteed. Logistical challenges, local competition, and regulatory barriers could slow down its overseas momentum. That being said, for investors who believe in the long-term future of EVs, NIO remains a high-risk, high-reward play with the potential for significant upside if it can execute on its expansion plans and improve financial stability. NIO is at a turning point. With major advancements in material science, battery swapping technology, and international expansion, the company is making moves that could reshape its future. However, the upcoming earnings report will be a key moment in determining whether NIO can capitalize on these innovations and turn them into sustainable growth. The company's ability to scale its technology, maintain financial stability, and expand globally will determine whether it becomes a dominant force in the EV sector or struggles to keep up with competitors. With an evolving landscape and technological breakthroughs on the horizon, NIO is a stock that investors need to watch closely. Do you think NIO is set for a major breakout, or are the risks too significant? Drop your thoughts in the comments below, and if you haven't already, subscribe and like for more in-depth analyses on the biggest disruptors in the EV market.